In this video, I'm going to show you the 3 big things that mortgage lenders look for when you're applying for a loan. Plus, I'll give you some tips on how to make sure that your tax returns are in order so that the process of getting a loan goes as smoothly as possible. Hi there, my name's Megan, and in this video, I'm going to talk about mortgages, specifically what mortgage lenders look for on your tax returns when you're applying for a loan. Now, most people think that having a perfect credit score is the only thing that matters, but that is not always true. There are actually several other things that lenders look at. And so today I'm going to break them down for you. So stay tuned because this is really important information if you're thinking about buying a house in the near future and you have any type of income that is derived and reported on your tax returns. In case you're new to our channel, we share information for homeowners, home buyers, and for the loan officers and realtors that serve you. We would love to have you subscribe, give us some feedback in the comments about any questions you have about what lenders have told you about your tax returns. So if you're one of the millions of Americans who own your own business or have joined the gig economy and you're no longer being paid a paycheck or W-2, then you most likely have or will go through the confusion and frustration of being told you don't qualify for a loan due to your tax returns, which is completely crazy considering you're making more money than you've ever made before or you have funds sitting in your bank account to use for a deposit, right? So before you go forming an army of other gig workers, make sure you watch this video to the very end because in this video, I'm going to give you a behind the scenes look at what underwriters are looking for on your tax returns when you apply for a mortgage or a loan. And I'm going to give you some super advanced tips to help tip the odds in your favor next time you go to apply. So mortgage lenders heavily rely on tax returns when underwriting applications for people who are self-employed. And as they provide lenders with this critical information about your financial health, for self-employed borrowers, it's especially important that you are understanding both your business and your personal income returns. Now, on the other hand, when underwriting borrowers who are employees of a company, there may be less of a need to cross-reference tax returns due to the fact that if your salary, it's consistent, it's reported on your W-2, you might not even need them. Nevertheless, tax returns are still required sometimes, even for employees, in order to verify their income. It can be useful to understand this information to help someone in your life, or if you ever think you may want to open your own business. So let's start with which of your tax returns do the underwriters need in underwriting? Underwriters are going to want the personal returns always to start. And then if you file a separate business return, they'll need those as well. And underwriters play a really important role in the home loan application process because they want to make sure that borrowers can repay their loans. Therefore, they're going to take into account both your personal returns and your business returns when they're looking at your overall financial situation with your credit. And they're usually going to require an applicant to give 2 years of tax returns to ensure that you have enough income, and they're going to average that income, not just use the most recent ones that are the best and the biggest and the fattest. They're going to use an average of the 2 years. And they're going to want to see a business return if you own more than 25% ownership in a company. So by reviewing both your personal and the business tax returns, underwriters then determine if there's any discrepancies in debts or income levels. And they're going to then say, okay, you either qualify or you don't. And this can be really frustrating for some people when they know there's a lot of money coming in. So why? And how do they even know what I'm really making? So another question I wanted to make sure I addressed is, do underwriters verify your information on your taxes with the IRS? And yes, they do. Underwriters do verify the source of your income. When you're self-employed, you are providing what goes on there. So they're going to make sure it's the same information that the IRS has that you're paying taxes on. Underwriters do this by obtaining what's called a tax transcript from the Internal Revenue Service. And tax transcripts include information about what an accountant or what you have reported to the IRS and what you should be giving to the underwriter when you're applying for a loan. And it gives them the information about how much income's reported, where it's being reported on, what type of wages, if it's tips, self-employment income from a separate tax return, if it's from retirement income. And underwriters use these tax transcripts just like if you were employed and they called and did a verification of employment. So now let's dig in further into, okay, fine, they're going to look at both these tax returns. They're going to check with the IRS. What are they looking for on these tax returns? So as a small business owner, you know that when it comes to getting a mortgage, lenders and underwriters pay very close attention here. You've got your gross self-employment income, but it's not the same as your taxable income. Your gross income is going to be much higher typically than what you actually are able to use when you apply for a loan due to the write-offs and deductions that you take. Deductions such as self-employment taxes, health insurance premiums, mileage when you drive somewhere, home office expenses, all those things can significantly reduce the amount of money available to be used to qualify when you go to apply for a loan. And understanding the difference in the gross amount and then your taxable amount is important so that you can accurately figure out what loan programs are best for your situation. They take these numbers and that's how they calculate your income. So let's dig into that a little bit more. When you apply for a loan, lenders typically need both the personal and business, like we talked about before, to calculate your income. The personal return allows them to evaluate how much you're taking individually and getting taxed on. And the business lets them dig in further and actually can help you qualify for more because your gross is going to be everything that you took in, everything, all the income. And then all the write-offs are going to write it off down to an amount that's going to flow over into your personal tax return. And it's that amount that flows over that you get taxed on that they're going to use to qualify you. So if you brought in $250,000 from all the work you did, and you wrote it all down to $50,000, you got taxed on $50,000, and $50,000 is what you should be telling your loan officer how much income you have to qualify when you go to apply for a loan. Now, how about those of you out there who are newly self-employed? For those of you who, let's say, recently, meaning in the last 2 years, you've transitioned and you've become your own boss, and you're probably wondering where this leaves you. You most likely don't have 2 years of tax returns and possibly don't even have one yet. So can you even get a mortgage? So the answer isn't black and white when it comes to qualifying for a mortgage loan when you're newly self-employed. However, what I can tell you is that you will not qualify for a traditional mortgage because almost every single traditional mortgage wants 2 years of tax returns. The only way to work around this is to find a cosigner willing to go on the loan with you on an FHA or a conventional loan. But if that's not an option, or you don't want to do that option, there are new loans. They're called non-QM loans that they don't require 2 years. Some of them don't even require 1 year. Now, many of these loan programs do want to see that you have been in the role of being self-employed for 2 years from when your business was filed. Even if you made no money the first year, they want to see that you're doing that, but they don't have to look at your tax returns for 2 years. So let's use an example. Let's say you became self-employed in February of 2021 and you filed 1 year of tax returns. It's now February 2023, but you don't have your 2022 taxes yet, and you would be eligible for a self-employed loan and you would meet the 2-year requirement. They would use their different options. You could just use the last 12 months if you really got ramped up. So there's also a few other loans, non-QM loans, that if you have remained in the same line of work, you're a sole proprietor, and you're now receiving, let's say, 1099 income, not W-2 income, like you used to receive, there are some other programs too that will help qualify you off your 1099 statements alone, the gross amount that you get at the end of the year. All of these specialty loan programs for self-employed borrowers will require more of a down payment, and they're not as lenient as the government-backed loans that you may have heard about, like FHA, but they are an option that can get you into a house. So what do you do then if you don't qualify for a home or the price range you want to and you're self-employed? If you find yourself in that situation, not being qualified, or your bank telling you they can't do a loan for you at this time due to your self-employed income, here are the options you want to consider. And one would be to wait and file another year of tax returns or higher income on your tax returns. You could also look into amending your tax returns, paying extra taxes in order to prove the consistency of your income. I like to encourage people not to do that and to instead look at the loan program specifically designed for you as a self-employed borrower. If you can show the history of your business being filed and opened for the last 12 to 24 months, speak to a loan officer who offers programs specifically for you being self-employed and can help educate you on what these products are, what options you have, and the necessary documents that you're going to need to show proof to be able to qualify. Now, before we finish up the video, this is probably the most important part, which is the actions to take to help you qualify in the future. Let's say it really just frustrates you. You can't do a normal loan or an FHA loan. There's a couple of things you can do to be able to qualify in the future without killing yourself in taxes. And the number one piece of advice is that every business owner that we work with is to educate yourself on how to review and read your tax returns. Even if you aren't looking for a mortgage anytime soon, you will save yourself more money and time by being able to read your tax returns. Remember, your accountant, your CPA is human and humans make mistakes. No one is going to care about the taxes you pay and your business more than you do. Over the past 5, 10, 20 years, I have caught and questioned my accountant a number of times after going through the tax returns and discussing it with her, and every single return, we would correct and update to reflect what really happened and should be on the returns. Some of these mistakes and misunderstandings would have cost me over $50,000 in taxes to Uncle Sam, something I try to keep at a minimum every year. My top 3 tips to help you when applying for a mortgage when you're self-employed. Number 1, do not mix personal and business expenses and bank accounts. And this is especially common with solopreneurs and certain lines of work. Let's use real estate agents as an example. You can follow a few simple steps that will give you a much better chance of qualifying for a conforming loan when the time comes, or even if it's a self-employed loan, it'll be a lot smoother. So these 3 tips are: number 1, open a separate business bank account. Megan Realtor LLC business. It's a business checking account, and deposit all of your real estate commission checks into this account. Pay your business expenses out of the business bank account that I just explained to open, and then transfer money afterwards into your personal account that you can use to pay your personal things like your mortgage and food and dining. Doing this will give you the ability to exclude payments that you pay out of your business bank account. So if you pay your car out of there, and you've done this for at least 12 months, when you go to apply for a loan, if you show proof that you've paid it out of this business bank account for 12 months, we can exclude your car payment from having to get deducted from your income. Number 2, designate one credit card for business expenses and pay that credit card out of that business bank account, because once again, you'll be able to exclude it from what's on your credit report. And then the third thing is get involved with the process of your tax returns and getting prepared. Educate yourself. You know your business way better than anyone else does. So if you're in the habit yearly of sending your CPA all of your bank statements, your credit card statements for them to sort, organize, you are going to miss out on writing off expenses that you could otherwise have reduced your tax liability. And my final tip is get comfortable with these new loans. Be okay paying a little more in taxes. Most self-employed homebuyers try to stay away from these other loans because the interest rate's just a little bit higher than on a conforming loan, but this is a big mistake. Yes, the interest rate's higher on these mortgages, but the total interest you'll pay on these mortgages in 1 year does not even come close to the amount that you will pay in taxes if you choose to instead not take your deductions that you're eligible for. And if you find yourself in a position where you're not getting qualified, make sure that you connect with an expert, someone who is a mortgage advisor who understands about being self-employed and can have a conversation with you about it. The process of obtaining a mortgage loan can be difficult even when you're self-employed, but even more so when you're self-employed. However, it is doable if you are organized and you find the right person. Don't give up. Make sure you plan ahead if you want a better chance at being approved. I'd love to hear what hurdles that you've had trying to get a loan in the past. Let me know in the comments. I'd love to hear your stories. And make sure you check out the blog that we have in the description below just to see some different terms that you should know if you're self-employed that could help you when you're going to get a loan, if you have to provide tax returns. And if you'd like to learn more about getting approved when you are a business owner or a contractor. Click the link in the description that says apply now and schedule a discovery call with someone on our team. This is 100% free and no payments required. We'll be there to guide you, answer your questions, and point you in the right direction. Self-employed borrowers are one of our specialties, and we have helped hundreds of business owners when others could not. We hope that this video gave you some of the insights that you're looking for and that you will join us for more information on one of our next videos. If you know somebody who could benefit from learning this information as well, please share the video with them. Hit that subscribe button and bell to get further notifications. Otherwise, continue to check out all of our other home buying, home owning, and mortgage broker tips and guides on our channel. I can't wait to see you next time.